Hello everybody, welcome to Arizona Home Goals. It's Javier, and today we're going to be talking about FHA loans in Phoenix, Arizona area. So by the end of the video, you're going to have a much clearer understanding of what FHA is and how can it apply for your future home purchase in Arizona. We're going to strictly focus on just FHA. So if you have other questions about other loan products, specifically conventional, maybe if you're a veteran, VA, feel free to leave a comment below. And if I get a lot of comments, then I'll definitely make it. But most of the time, people's journey starts with research on FHA. And then from there, a conversation starts with either a realtor or lender. So that's why I want to focus on just FHA. We're going to be using the MLS, and we're also going to be using my chicken scratch iPad drawing. So try your best. I'll make sure to explain and summarize everything as much as I can, but having a paper and pencil nearby and watching this video in chunks rather than all at once is going to be the best solution. If you watch it for the whole time, you're part of the chunk. You're not the chunk gang. You are definitely the full slice gang, the whole pizza pie. Hey, we've all gotten a large or medium pizza back in the day and end up eating the whole thing. I know back in my early 20s, Papa John's with that freaking garlic butter and that little pepper. So first and foremost, we're focusing not just Phoenix, we're talking Metro Phoenix, East Valley, Chandler, Gilbert, Mesa, West Valley, Goodyear, Buckeye, Surprise, North Phoenix, Scottsdale. This applies to almost, well, not Scottsdale because I don't know if the price works there, but we're going to specifically talk about FHA. And let's talk about what is it first and foremost. So FHA, it stands for Federal Housing Administration, and it's essentially a government-backed loan. It was started by HUD. It's a division of government that's in charge of housing in the United States of America. The FHA loan was introduced especially after the Great Depression to encourage home ownership. I remember back in the day, you would have to put like 20, 30, 50%. And now, of course, the prices were a lot cheaper, but it was really unstable, not only for home buyers, but it was also unstable for the investors, the people who purchase these mortgage-backed securities or these mortgages as a tool of investment. They buy big chunks of these. So what the government did is they created an FHA loan or FHA mortgage that's going to say, hey, these loans are going to be solid and they're backed by us. They're backed by HUD, meaning anything that has an FHA loan attached to it is guaranteed that HUD would buy it back if it ever fails, meaning if they get foreclosed on. That's why if you ever see a HUD home or like a foreclosure, a HUD home, it's basically an FHA mortgage that foreclosed. So, and if you see something else like a Fannie Mae foreclosure or anything else like that, then that is different. That's like the conventional loan or something else like that. Having this did two things. It gave investors a lot more confidence to invest in these mortgages because they know that they'll get at least some of their money back for sure because it's guaranteed by HUD. And secondly, it gave buyers a tool to access home ownership a lot more confidently, and they did that because they greatly reduced the essentially the minimum needed to buy a house, not only for your down payment, which is 3.5%, which we'll talk in a bit, but also the guidelines of needing it. They made it universal, so essentially it's a one-size-fits-all situation. If you have the standard entry point, then you can get in an FHA loan. Whereas conventional, there's different tiers, and if you have a lower credit score, you're going to be punished harshly. FHA won't work like that, which is what we're going to talk about here. Obviously, with FHA, the low down payment is the biggest thing. Having that down payment be nice and accessible gives homeowners the ability, or well, not homeowners, but people the ability to become homeowners. You don't have to go save 20%. And now, and especially in this market where houses are 300, 400, 500K, especially in the Phoenix area, then 20% seems like it's something that's never obtainable. So 3.5% makes it a lot more doable. The interest rate is right now at the moment lower. Obviously don't know how to use my iPad or what, right? Quite yet. The interest rate is a lot lower right now than conventional. Only like 1 or 2 points. Now that's, that changes over time. Sometimes conventional will be better, but it's kind of crazy right now because, I had somebody recently call me and they're like, hey, I have like an 800 credit score and they just quoted me conventional for like 6.9%. But if I wanted to go FHA, it was like 6.6, 6.7. What the heck? What's going on? Why is it like that? Well, it's just the way things are right now. FHA is a little cheaper. And of course that could change, but the beautiful thing about FHA is regardless if you have a credit score of 600 or 800, you're getting the same rate as everyone who is currently at that moment buying FHA, which can be a good or bad thing depending on how hard you worked. Obviously a great thing for those who are getting started in life or maybe previously have made mistakes like myself. Like maybe we weren't that great with our credit in our younger days because we didn't get financial education from our parents. We only got a little trauma from them. We have to kind of make up for that, and maybe your credit's still recovering in the 600s. This is perfect for you. And like I said, I probably shouldn't circle these. I should probably highlight them. So we'll highlight them from now on. Get your foot in the door. So you can get a house, get FHA, and over time as you live in it, once rates get better, then maybe you can refinance. Once you have that higher credit score, or you have some savings, or you have that equity built in, you can refinance it to a conventional, depending if the rates drop. Or maybe you just stay with FHA, but you probably want to refi to a conventional because of the PMI or mortgage insurance, which we'll talk about in a bit. So it has a bad reputation with realtors. There's a lot of realtors that are really dumb out there. So like if you have two offers that are identical, they have a conventional and an FHA, and they're the same exact price, same exact terms for the seller. The agent will tell their seller, hey, FHA, this person probably is not as solidly qualified as a conventional one. They're always going to think just because you're FHA, you're barely qualifying, or you had a hard time qualifying. And it's honestly ignorant, because like I said, there's people out there that have amazing credit scores that are still doing FHA because the interest rate's much better. So you're going to have to battle that. And obviously you have your realtor. If you're buying in Phoenix, hopefully I'll be that realtor, so you don't have to worry about that, because I'll be fighting those fights for you. But really make sure that that's being addressed if that is a pre-existing thought or idea that the agent has, the listing agent rather, not the buyer's agent. Hopefully your buyer's agent doesn't have that. If your agent ever scoffs or makes you feel bad for having FHA or qualify with FHA, you should probably let that agent go, because that's not what you need. You need someone to fight for you and not be like, oh, FHA, or you need to be conventional. The PMI is permanent, or the mortgage insurance, which we'll talk in depth a little bit later, so just hold off on that. And the closing costs are higher. A few reasons why. I think overall the lenders charge more to do FHA, but there's two types of mortgage insurances in an FHA. There's the ones you pay a month for the rest of your life, and then there's like a one-time fee that you pay, like it's a certain percentage. I think it's might be one, or I don't remember the percentage that they charge you up front, and it actually either gets paid as a closing cost, or they add it to the loan. So we'll talk a little bit about that later, but no, that it is more expensive to buy with FHA. Let's talk about the summary. But before we do that, I want to give you an idea of how many houses sold over the last basically 12 months or last year in Arizona or Phoenix. The whole RMLS, which is basically Maricopa County. Everywhere, there's 59,302 sales that are single family detached homes in the last 12 months. Out of the 59,302, how much do you think were FHA? 8,799. Approximately 15% of houses were FHA. They're not massive. I'll give you that. It's not like a bunch of them, but it's always been that way. Conventional is usually about 50%. Let's see if that's the case, which would be 30,000-ish here. Yeah, 30,000, 50%. Cash is usually a big chunk at 15 to 20%. So there's more cash sales actually than there is FHA. So let's look at the summary. First things first. Oops, sorry. 3.5% down. What does 3.5% down mean? Well, an example is out of $400,000, that down payment would be $14K. Your closing costs on an average, I'd say, is 2% to 3% if the taxes are higher, but usually it's about 2.5%. So let's say 7 to 8K. So normally you want to do, like, for a $400,000 house, I predict your down payment would be $14K, and your closing costs will probably be about $8K. So you're looking at $22,000 to $24,000 around there for your out-of-pocket costs if you don't get the seller to cover your closing costs. There's no restrictions on location and income, which is great. I know there's a lot of like down payment assistance programs out there that say, hey, you cannot make more than 80K. You can only buy in these certain zip codes. You can buy anywhere with FHA. You can, with no restrictions on your income, you could be making the big bucks. You can make in the small bucks. As long as you qualify, obviously, big difference. Minimum credit score is 500. Essentially, you could buy if you wanted with as low as 500, but then there's heavy modifications. Like they change like the terms. I believe they adjust the interest rate as well. So really, I do recommend you should be 600 plus. I think 600 to 700 if you're FHA. If you're in the low 500s, it's in my opinion that you should probably do the work to get yourself back to 600 position before you look. However, if that option is available for you, you could go as low as 500 with some lenders. The con, or it's not a con, I guess it's good or bad. There's no restrictions to location and income, but relatively has to be in good shape. When the appraisal is done on the home, which, well, I guess we can maybe do a video about that later point. When the appraisal is done on the home, you're going to have the appraisal go out there and not only verify what the value is, but they're also going to verify the condition of the home. They're going to look out for specific things that if it's an FHA appraisal, they look out for, like the condition of the roof, the flaking, like paint, to make sure there's no flaking paint chips and stuff like that, the condition of the appliances. So it has to be in good shape. They're not going to just take any house. So that means if you're trying to be one of these investor daddies or mommies that are out there, trying to make a buck, you're not going to be able to do it with FHA easily. FHA is for first-time home buyers, or not first-time home buyers rather, but for home buyers who are looking to not invest. If you're looking that route, conventional is going to be the way to go. The good news is you do have a much more flexible debt to income ratio, which we'll talk about in a little bit. So essentially when they qualify you, they look at your debt to income. So they get your monthly debts versus your monthly gross income, and that's how they figure out what you qualify for. So technically, because it's more flexible at 56%, you can qualify for more of a house with FHA than conventional, being only at 45%. However, you shouldn't be buying with, you shouldn't be maxing out your debt to income ratio anyways. If you're buying with, 56% of your gross income, which by the way is not even your take home, gross is before take home. So really it's like 60 or 70% of your take home, you can qualify, but you shouldn't, because you're going to put yourself in a terrible position where you'll be house poor. Okay, don't do it. And of course, the biggest negative I see is that mortgage insurance is a perm. Usually my hair's longer and it's curly, and you'll see I have a perm. What I mean is permanent, not perm. Permanent. So you're always gonna have mortgage insurance. There is certain exceptions of like, oh, Javier, if you put 10% or 11% down, and oh yes, and you can also, I believe, pay off your mortgage insurance when you buy the house. There's certain ways to do it, but most, like 99% of the time in this case, your mortgage insurance is going to be expensive and it's going to be permanent. I should also add that because that's a big factor. It is expensive. I just got a craving for Federico's or Filiberto's quesadilla. You got to watch out because there's a lot of Federico's and Filiberto's out there, but there's the best ones in my opinion are the ones that use like a yellow cheese. If they use a white cheese, it's going to be decent, but there's like specific Federico's or Filiberto's out there that use a yellow cheese. That's where you want to go. And I just got the craving for that. So mortgage insurance is there. It's there and it's permanent. You're never going to get rid of it, which we'll talk about in a bit. A lot of things we're going to talk about in a bit. So basically, just to recap, mortgage insurance, we're going to talk about in a bit, and debt to income ratio. Your loan limit. So in Maricopa County, your loan limit's at $530,000. This gets adjusted yearly depending on essentially the gross income of or I think it's median income of the area of people living in Maricopa County. So right now the loan limit's $530,000. So your loan cannot exceed $530,000. This doesn't mean your purchase price, because remember you're putting 3.5% down. So I guess the purchase price would be, I don't know, like $550, $545-ish. I don't know. You can do the math there. But your loan amount has to be $530,000. And if you want to use FHA, you would basically, you could buy a $600,000 house, but you're putting $70,000 down. Your loan is only going to be for $530,000. But if you're doing that, you might as well go conventional, right? So essentially, that's a quick boil down of what it means. But let's talk about the biggest negative of a FHA loan, which is going to be that mortgage insurance. So when you have a house, so there's 5 factors in the mortgage payment, okay? There's going to be your principal, your interest, there's going to be your home insurance, your taxes, and I wasn't going to write PMI, but it's like MIP with FHA and PMI with conventional, so I'm just going to call it mortgage insurance. So your principal and interest, this is the number you can find by just doing any mortgage calculation online. Essentially, it's kind of a calculated, complicated formula, but which fun fact, if you are looking to work with me, if you go to Arizona Home Goals, you make an account, and you actually have a conversation with me, I do send you, for Patreon, people have to pay $10 to get I have a sheet with a bunch of home buyer resources, including a mortgage calculator. You don't have to pay $10 for that. Just start the conversation with me, make the account online, and I will send you that. So heads up for anyone looking to get that for free. Super secret, the main channel, which by the way, I don't know if you know this, I have a main channel with 150K subs. They don't know that, so keep it on a DL, please. So principal and interest. That is just what essentially you get just by calculating any mortgage online. That's essentially the loan part of it. So think about the loan, you're thinking about this. The third thing is the home insurance. So there's going to be an annual premium. So there's an annual premium, and essentially it gets divided by 12, and that's part of your monthly payment. $400,000 house, your payment's probably going to be in the mid 2000s or in the 2000 range around there. So let's assume like this would be like $2,000. If your home insurance is like I don't know, $1,200 a year, that would be $100, right? Because you divide that by 12. Your taxes are the same way. You look at the annual, what they charge you annually. Some areas are like super cheap, like $500-600 a year. Some areas are not so super cheap, like $2,000 to $3,000 a year. But it's not as bad as Texas and Florida. They're paying $12,000 to $15,000 a year, right? So at least we don't have that. So whatever your annual is for your taxes, same thing, divided by 12, and you get that number. And then there's your mortgage insurance. So we can have a great situation where like combine your 1 and 2 could be like $2,000. Your insurance can be $1,200 a year, which is like only $100 more. If you live in a low tax area, like, okay, great. You pay, I don't know, $1,000, that might be $80. But let's just say $2,000. Let's say you're buying in an area where the taxes aren't so cheap. So then that would be, what, $2,000 divided by 12, $166. And then, so that's, what is that, $2,266? So far, not bad, right? Looking pretty decent. And then the fifth one is your mortgage insurance. And this is the part that sucks with FHA. Your mortgage insurance is essentially, you're paying when you're buying through conventional, right? The more risky you are, the more you have to pay a month, because you're paying essentially an insurance on your mortgage. Like, we don't trust this guy or gal, and they're going to pay us a little insurance policy. So if they ever foreclose, that policy kicks in, and whoever owns the actual or the loan gets paid the majority of their money, and they're good. Now, if they're super risky for conventional, you might get like a $300 or $400 mortgage insurance a month, because like, we don't trust this guy. We'll give them this loan and they qualify, but we're gonna really cover our butts here. They're gonna have, because you're riskier, so the policy's riskier. Now, if you have amazing credit, like you're 850 plus, you never made a late payment in your life, that mortgage premium could be like $20 or $30 a month, really, really low. And that's why I tell people all the time, because if you put 20% down on conventional, you don't have to pay PMI because you're not risky anymore. But it's like, hey, if you have a great credit, why? I mean, I get it, but you're going to be paying a little anyways. So with FHA, it doesn't matter what your credit score is. It doesn't matter how amazing you are. You could be literally the son of Mr. FHA and Mrs. FHA. I don't think that exists, but you get the point. Nepotism will not help you. You're going to be paying a lot in mortgage insurance. Last I saw, it's like between $200 to $300. Dare I say $400? We'll just cover my butt and I'll do up to $400. But usually it's like, I see a $200 to $300-ish range, and it's always high. So your payment will definitely bump up to like what, near $2,500-ish, around that. I don't know. So it's around there. So that's the part that sucks. It's always going to be higher, and doesn't matter how much more down you put, because like with conventional, you can put more down. You can go back in 6 months, work on your credit, come back, and it'll be lower. There's all these other things you can do. FHA, you're like, hey buddy, just because you're using FHA, it's going to be higher. On top of that, you're going to also pay a mortgage insurance premium, an MIP, which is an additional fee you pay to protect the lender's financial interest. So it's like not only do you pay it monthly, but there's a upfront MIP, which is 1.75% of the loan that gets added to the loan amount. So if you're buying a $400,000 house, you might see in the closing statement there's an additional 1.75 added to it, because that upfront MIP. Now, there is a way for you to pay it upfront, but most of the time they're just added on the loan, and that's unfortunately a part that's going to suck, but that's just how it rolls with FHA. So let's talk about the 56% thing I was telling you. So yeah, one of the good news is your DTI, or your debt to income ratio, can go up to 55%, which is great. But this is how they calculate what you qualify for. They get your gross monthly income, they divide it in half, or if you don't like doing division, you can multiply it by 0.50. And whatever that number is, which we'll call X, okay, they subtract all of your minimum payments on everything on your credit. So like your car payments, your minimum payment for your credit cards. We're not talking about your rent. We're not talking about your insurance. We're not talking about anything else. Only what's on your credit and what the minimum payment is. They subtract that, and that equals Y, which Y being what you qualify for. Now, there's a difference between what you can qualify for and what you can afford. Now, on my main channel, I've made wonderful videos about this. I just made a video talking about 400,000. I think if you need to qualify up to 400,000. You can go watch that for sure, because it does a much better job explaining this. This is just a very simple way of looking at it. But you have to be careful here, because now here with FHA, this isn't 50%. This is 55%. So in theory, yes, you qualify for more. Congratulations. You can get more money. We can do this. Use an example. Let's say you're making approximately $6,000 a month. We multiply that by 0.55. That equals $3,300. So yes, you qualify for an... Those zeros are tiny. Let me try that again. You qualify for an additional $300 with FHA. Okay, so yes, it technically is nicer. However, it's still not decent because that's just your gross. They're using your gross income. This is gross. Your net income probably looks closer to 5,000. And when you're using your budget, you want to use your net income. And so let's say you're making 5K, you're bringing actually home 5K. You could qualify up to 3,300, but the problem with that is 66% of your take-home income. You want to make sure this number is less than 30% as a rule of thumb to not be house broke. Okay, so it's a bonus of FHA, sure. And it makes it more attractive, I guess, because it's more, if you really, no, I don't think, maybe it makes sense. I've seen it make sense where like there's like not a spouse, but maybe you're buying a house with your parents and they provide you income every month, and that's not necessarily on the loan, but like they're giving you money a month, and it's part of the budget, like the main budget, right? So and you're barely qualifying at up to 55%, and on paper it doesn't look smart budget wise, but you qualify. But you know, you're actually getting money from your parents, you're getting money from your roommates, you're getting, you know, guaranteed money in other sources. Then that makes sense, I guess, but rarely does it make sense to do this. So please make sure to do your research. Now, last but not least, let's say what areas work for FHA. Well, first and foremost, when you agree to work with me, we'll do a home buyer consultation where we'll set up your search. But I mean, it's quite simple. The first thing first, you cannot buy less than, well, I think it was like 550. 530 is the, I think, the loan amount, but you know, let's just say 550 to be the actual price of the home. We would divide it, I believe, by 0.96 and a half. So yeah, 549. So 550. Yeah, you cannot buy under 550. So off the bat, I mean, that's gonna reduce your ability right there to 4,175 matches. So let's say we're focusing in the Metro Phoenix area. Focus in on East Valley first and see what pops up there. I mean, you're not gonna be able to buy in Scottsdale for sure. There's maybe a few houses here and there. Look, majority of the areas, as long as it's under 550, it works. Now, you do want to make sure to actually put FHA financing, because there are some houses that might not work for FHA because they're just in terrible shape and the lender, or sorry, the agent didn't put it applicable for FHA. So make sure to put that. In this case, 456 options. It works. Now, of course, the West Valley will provide more options because houses are cheaper over there. So yeah, it's like triple more options. I did add Phoenix though. So, but that's technically part of the West Valley. So essentially 3 times more houses are available in the West Valley at FHA. So basically, if you're looking to get a home and you're in a position where you're still working on your credit and you have, you know, all the things you need, what I believe you need to buy a house right now, you have your savings in line, you have an emergency fund set up, you have your credit in line, like you don't have any outstanding like high credit card balances, you have the motivation to buy, you have the sense of urgency to buy, and you're just like, Javier, I don't care what you say, I'm moving out of my house next month and I don't want to have a landlord. Great. Well, in that case, FHA is good for you. You should definitely explore your options. Even though it's a government-backed product, you want to make sure to get different opinions from different lenders. I had someone recently who had a lender quote with one of the lenders I recommended versus like in Rocket Mortgage, and the lender I recommended, somehow the interest rate was way better and the fees were a lot better. So you still want to do your research. And of course, if you're looking to work with me, there's 3 ways to get a hold of me. Down there below, there's my phone number, my website. I'm happy to, you know, during our consultation, set you up with my recommended lenders and just get the ball rolling. The thing you need to really focus on, that I want to make sure you really drive this home, is it doesn't matter if FHA. Everybody starts off with something. My first 2 loans were FHA, and that's okay. I don't want anyone to make you feel crappy or bad about it. At the end of the day, when you have the keys to your home and you own your home, you know, it doesn't matter if it's FHA or conventional. It's yours, and there's no one else that owns it. And you own a piece of property in the United States of America, and that's all that matters. So thank you guys for your time. I appreciate you. Have a good one.